Welcome back to International Financial Management. In today's lecture, we are going to cover three important and interconnected topics. First, TT rates, which stands for telegraphic transfer, and bill rates. These are the foundation of how banks quote exchange rates to their customers. And after that, we will study the letter of credit, which is one of the most critical instruments in international trade finance. We will also look at FIMDA, what it is, what it governs, and how it relates to your study for international finance. By the end of this lecture, you will be able to calculate TT buying and selling rates, bills buying and selling rates, and understand the role of letter of credit in trade, and also distinguish between FEDAI and FIMDA. Before we dive into formulas and calculations, let us first build the right mental framework. When a bank exchanges foreign currency with the customer, whether it is buying dollars from an exporter or selling dollars to an importer, it always charges a margin. That margin is how the bank earns its profit. However, the size of that margin depends on the risk the bank is taking in that particular transaction. The higher the risk or uncertainty for the bank, the larger the margin it is. So, the key question is, what determines that risk? The level of risk depends largely on the type of transactions involved. Broadly, foreign exchange transactions can be divided into TT transactions and bills transactions. Let us discuss TT transactions. Look at this slide. TT stands for telegraphic transfer. This is the oldest terminology. It goes back to the days when interbank instructions were sent by telegraph. Today, this is done through SWIFT, but the term TT has stayed. Now, the TT rate is defined as the base merchant rate. It applies when there is no transit risk, no delay, and no extra waiting period in the transaction. In simple words, the foreign currency has already been received or will be received immediately. Now let me explain it. Think about it in this way. If you give $1 to a bank and the amount has already been received in the bank's foreign currency account, there is almost no risk for the bank. It can simply convert the dollars and give you rupees immediately. There is zero waiting time, zero uncertainty, and in that situation, the bank charges the bare minimum margin, that is the TT margin. This is why the TT rate is considered the cleanest, lowest risk rate. It is the starting point, which is the benchmark, from which all other merchant rates are derived. Everything else, that is, bills buying, bills selling, is just the TT rates adjusted for risk and time. Now, let us look at TT buying rates. This is when the bank is buying foreign currency from the customer. Now, here who is the customer? Is typically an exporter who has received US dollars from abroad and wants to convert them to Indian rupees. Now, when does the TT buying rate apply? It applies when the bank's nostro account abroad has already been credited. Nostro account is an Indian bank's account held in foreign bank abroad. If the account is already credited, it means the dollars are already there. No transit, no waiting. Now let us look at the TT buying rate formula. The formula is TT buying rate is equal to interbank buying rate minus exchange margin. The logic is straightforward. The bank buys the currency at the interbank rate, the wholesale rate between banks, and then deducts its margin before paying the exporter, so the exporter gets slightly less than the interbank rate. Let us take an example. If the interbank buying rate is 84.50 and the exchange margin is 0.10, then TT buying rate is equal to 84.50 minus 0.10, which is equal to 84.40 per USD dollar. The exporter receives 84.40 for every dollar sold to the bank. This rate is used for export proceeds received via SWIFT or clean remittance, situations where the money is already in the bank's nostro and no documents are in transit. Now, the TT selling rate. This is when the bank is selling foreign currency to the customer. Now, who is the customer now? Typically an importer who needs dollar to pay foreign supplier or someone sending an outward remittance. In this case, the bank simply debits its nostro account abroad and transfer the dollars. No delay, no documents in transit, clean and immediate. The formula TT selling rate is equal to interbank selling rate plus exchange margin. Here, the bank adds its margin on top of the interbank selling rate. The importer pays slightly more than the interbank rate. That extra margin is the bank's earning. For example, if the interbank selling rate is 84.80 and the margin is 0.10 rupees, TT selling rate is equal to 84.80 plus 0.10, which gives us 84.90 per USD. This rate is used for outward remittances, import payments, and demand drafts issued in foreign currency. Look at this key relationship on your screen. TT buying rates is less than interbank rate, which is less than TT selling rates. This inequality is fundamental. The bank always buys low and sells high, and this is the spread, that is bank's gross margin. For the exporter who is selling dollars to the bank, the TT buying rate is the best they can hope for in the cleanest possible scenario. Every other buying rate will be lower than TT buying. For an importer who is buying dollars from the bank, the TT selling rate is the best selling rate. Every other selling rate will be higher than the TT selling. Now let me explain you TT buying rate and selling rate with help of an example. We have been given interbank USD INR rate where 84.50 is the buy rate and 84.80 is the sell rate. Now exchange margin given to us is 0.10%. Find TT buying and TT selling. Now here the TT buying is equal to interbank buying minus margin. We have been given interbank buying, which is 84.50. So we will write here 84.50. Now this minus margin is on 84.50. So 0.10% of 84.50. So this comes out to be 84.50 minus 0.0845, giving us 84.42. Now let us talk about TT selling rate. Selling rate, now this is equal to interbank selling plus margin. Now here 84.80 is the selling rate. We will add the margin, which is 0.10 of 84.80. Now this gives us 84.42. 84.80 plus 0.0848, giving us 84.88. So now we will talk about the spread. The spread, TT spread, is equal to 84.88 minus 84.42, which is equal to 0.46 rupees per USD. So bank earns around 0.46 rupees per USD. Now here, if you see, this is the selling rate, and when it is used, when importer buys dollar, right? So the bank sells at this TT selling rate. And now this is the buying rate of the bank, TT buying rate, and when it is used, when the exporter sells dollar. So this is the rate used. So hence the difference between these two will give us the profitability of the bank. Now let us step into more complex scenario, which is bill rates. Consider an exporter who has shipped goods to a foreign buyer. After shipping the goods, the exporter prepares a bill of exchange, which is a written document asking the foreign buyer to pay a certain amount, either immediately or on future date. The exporter then takes the bill to their Indian bank and say, "I do not want to wait until the foreign buyer pays. Please give me the money now." The bank agrees and purchases the bill from the exporter. This means the bank pays the exporter immediately in rupees and then waits to recover the money later from the foreign buyer or the foreign bank. Because the bank has to wait and there is a chance of delay of non-payment, or this type of transaction involves more risk than the TT transaction. Here is the key difference from the TT. The bank's Nostro account has not yet been credited. The bill is still in transit. The foreign banks needs to process the document and then make payment. This takes time, typically 20 to 25 days. During those 20 to 25 days, the bank bears the risk. What if the foreign bank delays? What if there is a discrepancy in documents? What if something goes wrong? The bank absorbs all of that uncertainty. Because of the risk and the time value of money, the bank deducts interest from the transit period before paying the exporter. This is why the bill buying rate is always lower than the TT buying rate. The RBI and FEDAI have standardized the transit period, called the normal transit period or NTP. These are standard values that you must remember. For air cargo, the NTP is 25 days. For sea cargo through a short route, it is 20 days. And for a sea cargo for long route, which is via USA, UK, Europe, is 25 days. Why standardize? Because banks need a consistent basis for deducting interest. Whether the actual transit takes 18 days or 22 days, the bank applies the standardized NTP to calculate the interest deduction. Now the formula for bill buying rate. Watch this build up step by step. Formula is bill buying rate is equal to TT buying minus interest for NTP. And the interest is calculated as interest for NTP is equal to TT buying rate into interest rate into NTP divided by 365. This is simple interest, not compounding, applied for the NTP period. Let's work through the example given TT buying rate is how much? 84.40. NTP is 25 days. Interest rate is 12% per annum. Now calculate interest. Interest is equal to 84.40 into 12% into 25 by 365, which gives us 0.6938, approximately 0.69. Look at the comparison. TT buying was 84.40, but the bill buying rate is only 83.71. The exporter gets 0.69 less per dollar because the bank is absorbing 25 days of transit risk and funding cost. This is the crucial insight. Bill buying rate is lower than TT buying rate because the nostro is not yet credited and the bank absorbs transit risk. The more days of transit, the greater the deduction and the lower the bill buying rate. Now the other side, the bill selling rate. This applies when the bank is funding import bills, and this is paying on behalf of the importer for goods the importer has purchased. In a typical import letter of credit transaction, the buyer pays the foreign seller's bank when documents are presented. The importer may not need to pay the bank immediately. There could be a credit period called the usance period. During this time, the bank has already paid abroad but has not yet recovered the money from the importer. This is the bank's funding risk. It has deployed its fund and must wait. The extra time the bank funds the transaction, the more interest it charges the importer. So the logic is extra risk is equal to extra interest charged, and that get added to the TT selling rate to arrive at the bill selling rate. What is the usance period? In import finance, a time bill, also called a DA bill or a documents against acceptance bill, gives the importer a credit period before payment is due. Standard usance periods are 30, 60, 90 or 180 days. The bank funds this gap. Naturally, a longer usance period means a higher bill selling rate because the bank is financing the importer for longer. The formula for bill selling rate mirrors the bills buying rate but not the selling side. Bill selling rate is equal to TT selling plus interest for usance period, and the interest for usance period is equal to TT selling into interest rate into usance days divided by 365. Now let's take this example. TT selling rate is 84.90, usance is equal to 30 days, interest rate is equal to 12% per annum. So interest for usance period is equal to 84.90 into 12% into 30 by 365, which gives us approximate figure of 0.84 rupees per dollar. Now we have to calculate bill selling rate. So what we will do? We will add 0.84 with 84.90, which gives us 85.74 rupees per USD. So the importer who buys on 30 days usance period pays 85.74 per dollar compared to 84.90 on TT selling. The difference of 0.84 rupees per dollar is the interest the bank charges for funding the importer for 30 days. Bill selling rate is higher than TT selling rate because the bank pays in advance and the importer pays extra interest. Longer the usance, higher the rate. Let us now pull everything together in a comparison table. This table is your anchor. Memorize the logic, not just numbers. But why each rate is lower and higher? That we are going to study here. TT buying and TT selling rates involve very little risk for bank because the bank's nostro account has already been credited or debited depending on the transaction. Therefore, no interest adjustment is required and the base exchange rate is used. In bill buying transactions, the bank has not yet received the foreign currency in its nostro account. Because the bank has to wait for the money to arrive, it faces transit risk and deducts notional transit period interest. Therefore, the bill buying rate is lower than the TT buying rate. In bill selling transactions, the bank pays the customer before it receives the foreign currency. Because the bank is funding the transaction during the usance period, it faces funding risk and adds usance interest. Therefore, the bill selling rate is higher than the TT selling rate. Let me give you the complete rate hierarchy from the lowest to the highest rate possible. But before doing that, let us understand the difference between bill usance and bill demand for exporter. Bill buying is mainly an exporter side transaction. A bill buying demand transactions relates to demand bill or site bill where payment is expected immediately when the bill is presented. The bank only faces transit risk because it has to wait for the documents and money to arrive. Therefore, only notional transit period interest is deducted. A bill buying usance transaction relates to the usance bill or time bill where payment is due after a credit period such as 30, 60 or 90 days. In this case, the bank has to wait not only for the transit time but also for the usance period. Therefore, the bill buying rate is lower because the bank deducts interest for both transit period and usance period. Let me now give you the complete rate hierarchy from the lowest to the highest rate possible. Starting from the bottom, bill buying usance is lowest. This is TT buying minus both NTP interest and usance interest. The exporter gets the least in this scenario. Then let's talk about bill buying demand. This is TT buying minus NTP interest only. The next is TT buying rate, which is the base buying rate for the exporter. Then we have interbank mid rate, which is not available to the customers. It only acts as a benchmark. Then after that, we have TT selling rates, which is the base selling rate for the importer. Bill selling usance, which is the highest, that is TT selling plus usance interest. The importer pays the most. So, bill buying usance rate is less than bill buying demand rate, which is also less than TT buying rate, which is less than interbank mid rate, less than TT selling rate, and then less than bill selling usance. This hierarchy flows logically from the principle that the more risk the bank bears, the worse the rate for the customer, lower for the exporters and higher for the importers. We now move to one of the most important instruments in international trade finance, which is the letter of credit, commonly abbreviated as LC. A letter of credit is a written undertaking by the bank, called the issuing bank, on behalf of its customer. The importer, known as applicant, has to pay a specified sum of money to the exporter, who is also known as beneficiary, upon presentation of stipulated documents within a specified time. Let us break this down. First, it is a written undertaking by a bank, not by the importer. The bank is making the payment commitment. This is the essential trust mechanism. The exporter is not relying on the importer's promise. They are relying on the bank's guarantee. Second, payment is conditional on presentation of stipulated documents. This is the documentary control. The exporter is paid only if they present the correct documents: bill of lading, invoice, insurance certificate, certificate of origin, and so on. If the documents comply, the bank must pay. Third, there is a specified time. The letter of credit has a validity date and a shipment date. Everything must happen within those time frames. Now, why does this matter? Because in international trade, the exporter and importer often do not know each other. There is a high counterparty risk. The letter of credit bridges the trust gap by inserting the bank as the guarantor for the payment. The exporter ships goods confident the bank will pay. The importer releases payment through the bank, confident documents proves the goods were shipped. The letter of credit system is followed universally. In over 175 countries, governed by the Uniform Customs and Practice for Documentary Credits, known as UCP 600, published by the International Chamber of Finance. The key parties in the letter of credit transactions are applicant, who is the importer here, the buyer who requests the letter of credit from their bank. Then we have issuing bank, which is the importer's bank that issues the letter of credit. Then we have advising bank. This is the exporter's bank that advises the letter of credit to the exporter. Then we have beneficiary, which is exporter, the seller who receives payment under the letter of credit. And we have a confirming bank, sometimes a third bank that adds its own guarantee of payment, providing additional security to the exporter. The LC process works as follows. The importer applies for a letter of credit from their bank, which is the issuing bank. The issuing bank opens the letter of credit and sends it to the exporter bank, which is the advising bank. The advising bank informs the exporter that the letter of credit has been received in their favor. Then the exporter ships the goods and collects the required document, which is bill of lading, invoice, insurance certificate, and others. The exporter presents this document to the advising bank. The advising bank forwards the document to the issuing bank. The issuing bank examines the document. If they comply with the letter of credit terms, it makes payment. Then it makes payment. The issuing bank releases the documents to the importer, who uses them to clear the goods from customs. The key principle throughout this process is documents, not goods. The bank deals with documents. It does not inspect the actual physical shipment. Compliance of document is what triggers payment. The typical documents required under an LC include commercial invoice stating the value and description of goods, bill of lading, which is the transport document proving goods have been shipped, insurance certificate covering the goods during the transit, packing list, details of how goods are packed, certificate of origin proving the countries where goods were manufactured, compliance with LC terms, all other conditions specified in the LC itself. Every single document must match the letter of credit terms exactly. Even a minor discrepancy, a different spelling, a slightly different description can give the bank grounds to refuse payment. This is why compliance is so critical. Now let's understand the benefits of letter of credit, that is why we use letter of credit. The key benefits are: one is risk mitigation. Both payment risk and merchandise risk are reduced. The bank guarantees financial performance. The documents ensure material performance. Financial security. Payment is released only after the conditions are met. No disputes about whether goods were shipped. Enhance business relationships. Creates trust between parties who may be dealing for the first time or across different legal systems. New market access. allows business to expand into new international markets where they have no established relationship. The letter of credit provides the trust infrastructure. Transaction flexibility. Letter of credit terms can be customized for different types of contracts and conditions. Now that we have understand the different types of forex transactions such as TT bills, letter of credit, the next question is how do banks decide the actual exchange rate to quote for these transactions? Banks do not set these rates randomly. In India, they generally follow market benchmarks and guidelines issued by FEDAI and FIMDA. These guidelines help banks calculate TT buying, TT selling, bill buying, and bill selling rates in a consistent manner. Because in the any forex transaction, TT rate or bill rate or LC discounting, there is an embedded interest rate. The forex rate gets you the exchange component, but the interest component, that is the benchmark rate, used to calculate interest on transit periods and the usance period is governed by FIMDA published benchmarks. So, in simple terms, FEDAI governs the foreign exchange rates, which are the TT rates, bill rates, LC rates, while FIMDA governs the interest rates and benchmarks embedded in those forex transactions. Now, look at the benchmarks now. FEDAI is associated with USD in Indian rupee reference rate through RBI, while FIMDA is associated with benchmarks. In terms of foreign exchange and LC relevance, FEDAI directly governs all LC related foreign exchange rates. FIMDA does not govern the exchange rate itself, but it provides the interest rate benchmarks that are used in LC discounting and similar funding calculations. Let's quickly recap what we covered in this lecture. We began with TT rates, the base merchant rates applicable when there is no transit risk. We then moved to bill rates. The bill buying rate is lower than the TT buying because the banks bear transit risk during the normal transit period. We then studied the letter of credit, one of the most important instruments in international trade, covering the definition, parties, process. Finally, we looked at FIMDA and FEDAI in governing these TT rates and bill rates as well as LC. Thank you for now. See you in the next lecture.